Good day, and once again, welcome to my Finance Friday channel. My name is Patricia Chimezi. I am an engineer and also a financial advisor. On my last video, I talked about the concepts of annuity. Today, I'm going to talk about the accumulation and payout period. Annuities possesses a benefit unknown to other financial products. Whether retirement is by the corner or decades away, an annuity can be a smart way for you to set up a better retirement and guarantee you will have regular income for the rest of your life. Investments and savings accounts can be depleted and leave an individual with no other resources in their financial needs. Annuity, on the other hand, gives you payments that are guaranteed to last for life. Suppose that you have a sum of money with which to support yourself for the rest of your life. If you spend too much of that money in a month, you will run out of money while you are still alive. If you spend too little, you will not maximize the use of that money and you will die before you use up the money. An annuity eliminates this uncertainty by converting a sum of money into a series of periodic payments that is guaranteed to last a lifetime or even longer. An accumulated retirement fund can be converted to a future income stream via annuity. What if you do not have a sum of money for a retirement fund? Well, annuity can also be structured to allow you accumulate funds over time before payments or distribution begins. Let's say that you do not need a lifetime income right away, but you will at some point in future. By setting aside a little of your income, you could accumulate a sum of money over time that could eventually be converted into a stream of lifetime income payments. Like all insurances, annuities are designed to alleviate a risk that people face, in this case, the risk of outliving your savings. We all hope to live to a ripe old age. However, the longer we live, the thinner our financial resources become, until eventually our lifetime savings may be depleted. So few consumers are provided with defined benefit pension plan through employer. An annuity can fill this void. Annuity allows us to transfer part of our financial risk of outliving our assets to an insurance company. So annuity is similar to automobile or homeowners insurance, in that the insurance company absorbs the personal risk that each of us has in exchange for premium. Let's look at the payout period. Having accumulated enough fund, we reach that point at which we wish to begin using the accumulated money. Not, of course, all at a time, just enough of it periodically so that we can live comfortably. Each periodic annuity payment can be considered a blend of deposits and interest those deposits have earned. The annuity payment actually is made up of the principal deposits and the interest accumulation. But wait a minute. Since we do not know how long we are going to live, how do we know how much we can take out every now and then and still have enough, no matter how long we live? Well, we don't. We do, however, know from our mortality statistics that our average life expectancy is at the time we begin taking out the money. This is based on our sex and age as at the time we start taking out the money. We may live longer than this average or die before reaching this average. If we pull together with a lot of other people, we know that the law of averages will work over a large number of cases. The person who dies early, before their average life expectancy is up, will leave uncollected benefits for those people who surpass their life expectancy and needs extra benefits. The life insurance company is the organization that allows us to operate on this annuity pool. We pay our premium deposits into the company, which credits deposits with interest earnings and promise to pay us an income periodically for the rest of our lives, beginning, of course, at a future point. We take the risk that we die before getting all our deposits plus interest, and the insurance company takes the risk that we will live to a ripe old age. Now let's talk about instrumental payments. Annuity is often used generally to refer to a series of periodic payments, even if the number of payments is not contingent upon the longevity of the recipient. Number 1, life annuity payments. Life annuity payment is periodic payment of life annuity, and it is paid for the life of the recipient. It is computed based on the life expectancy of the recipient at the time payment began. However, payment will last for the life even if the recipient lives beyond this life expectancy. Another one is fixed period payments. Here, the recipient agrees that their payment will be paid for a fixed period of time, say 10 years, 20 years, or 30 years. The recipient will receive payments which will expire at the end of the designated period. Fixed amount payments. Here, the recipient agrees to take a fixed amount every month for the rest of the time. So the recipient receives fixed equal installments, which will terminate when the payment uses up the remaining deposits and interest, even if the recipient is still living. Fixed period and fixed amount payments are sometimes called temporary annuities, which I will talk about on my later videos. There are other types of annuities, and I will talk about this on my next video. Please remember to contact me if you have questions or if you want to know about other financial products. My phone number is 615-719-7896. Thank you and remain blessed.